My name's Ruben Bock, Portfolio Manager at Atticus Wealth. I'm giving you this portfolio update from my home office in Melbourne under a coronavirus lockdown. Portfolio returns has been surprisingly strong over the last 6 months. We went down with the market, but we've had a fantastic recovery and participated very strongly in that rebound. I'm going to talk through a few slides to give some sense of the economic backdrop and how the Atticus portfolios are positioned against that. This is an important chart to demonstrate what's been driving prices, which in all other cases would be profits. And I'm charting earnings in this blue line here, and you can see the big collapse in earnings in line with the coronavirus outbreak and a modest recovery in the earnings line since. The green line shows the price level for the US equity market, and it also went down savagely when coronavirus was outbreaking, but it also rallied well in advance of the earnings line. And the explanation for that is the red line, which is US money supply, which is money coming from central banks and governments to stimulate markets and stimulate asset prices. And what this means for investors going forward is this money supply isn't going anywhere. So it will create this inflated asset price environment with all the extra money swooshing around. The fallout from that is obviously valuations, which are by this chart having gone much, much higher as a result. Regular viewers of these videos will know that we've got a core position in Asian equities, which is the pink line in this chart. And we're in this position primarily because the valuation level is much cheaper than in other global regions. And that works for investors for two important reasons. Firstly, when things inevitably go against you, having that valuation support means you've got less downside. Whereas when you get things right and you have that opportunity for a valuation uplift, which can be a major windfall for your position. We have some reason to be conservative in our position in our portfolios, and that's how we sit as it today. And that's certainly because of that high valuation backdrop. The second reason is around some conservatism around how swift potentially a coronavirus vaccine is going to solve our economic problems and our social distancing problems. And what I'm referencing here is the HIV virus funding, which is something that's been around for many decades. We spend upwards of $20 billion a year, and thus far it's something that we haven't overcome. The final chart I've got here is called a government stringency index. And this is an important indicator for investors to follow because ultimately it's showing across the countries, China, Australia, USA and Germany, the level of stringency in those countries in terms of school closures, workplace closures and travel bans. What this chart is telling us right now is that across the globe, we're maintaining these social distance measures, and it's very hard for the economic cycle to recover whilst we maintain these parameters. And when we finally do see the tide turn here, it will also mean a change of the guard in terms of the equity sectors that will outperform in the market. Whereas to date, we've seen gold and tech stocks outperform. Our expectation is that may well change, and financials and Asian equities are likely to outperform once this stringency index also turns. And that's something we can talk about more in a future video update.